I am Emma Reporter, and you're watching CA Reporter. Tonight, we need to talk about a development that has a lot of Canadians raising their eyebrows. Reports are circulating that Alberta is moving forward on discussions around a major new pipeline agreement aimed at boosting crude exports to the United States. And as these conversations gain traction, political tensions in Ottawa are once again front and center. Now, let's ground ourselves in facts. Alberta has long been Canada's largest oil-producing province. According to official federal data and industry reporting, the vast majority of our crude oil exports already flow south of the border. The United States remains Canada's single biggest energy customer. That's not speculation. That's decades of economic reality. Our energy sector supports hundreds of thousands of Canadian jobs directly and indirectly, from Fort McMurray to fabrication shops in Ontario. But here's why this matters right now. Our economy is in a delicate place. The Bank of Canada's policy interest rate currently sits at 2.25%. Inflation has eased significantly compared to the peaks we felt in previous years. Headline inflation came in around 2.3% in early 2026, according to Statistics Canada. That's much closer to the bank's 2% target. We are finally feeling a bit of breathing room at the grocery store, even if prices are still higher than they were before the inflation surge. At the same time, there are cost pressures that haven't gone away. While the federal consumer carbon tax was canceled in April 2025, the industrial carbon price continues to rise. In 2026, that price is set at $110 per ton. That directly affects large emitters, including oil and gas producers. And we all know how this works. When costs rise for industry, there is always debate about how much of that cost flows down to consumers. So when Alberta pushes forward with discussions around expanding export capacity to the United States, the political stakes are enormous. For some, this represents economic strength and job security. For others, it raises climate and environmental concerns and questions about Canada's long-term energy transition. And in Ottawa, any move that shifts leverage toward the provinces can spark heated reactions. We have to look at this through the lens of our wallets. Our country's GDP is heavily influenced by resource exports. When oil prices are strong and export volumes increase, government revenues benefit. That can mean more fiscal room, potentially less pressure for higher taxes elsewhere. But if there's a political clash between federal and provincial leaders, markets notice, investors notice, and that can ripple into our dollar, our loonie, and our borrowing costs. Right now, Canadians are watching carefully. We've just come through years of high mortgage rates. Many families in the GTA and the Lower Mainland are renewing at rates higher than they locked in during the ultra-low era. Even with the Bank of Canada at 2.25%, we are not back to pandemic-level cheap money. So any major economic announcement, especially one tied to energy exports, feels personal. LES take a step back and ask ourselves why this pipeline conversation is surfacing now. Our economy is stabilizing, yes, but it's not booming. Growth has been modest. Statistics Canada has shown that household debt levels remain high, even as inflation has cooled to around 2.3%. Many of us are still juggling higher mortgage payments, elevated grocery bills, and rising insurance costs. So when Alberta signals that it wants to lock in more long-term energy sales to the United States, it's not just a provincial headline, it's a national economic story. We have to remember that energy exports are one of Canada's strongest bargaining chips. Oil and gas remain among our top export categories. When we increase pipeline capacity or secure new cross-border agreements, we're talking about billions in potential revenue. That revenue supports provincial budgets in Alberta, but it also contributes to federal tax intake. Equalization payments, federal transfers, and infrastructure funding are all tied in part to the overall strength of our economy. Now, politically, this is where things can get heated. Anytime Alberta takes a bold step on energy infrastructure, Ottawa faces pressure from multiple sides. On one hand, there are Canadians who see resource development as essential to our prosperity. They argue that if the United States is willing to buy more of our oil, we should seize the opportunity, especially in a world where energy security has become a global concern. On the other hand, there are Canadians who worry about emissions targets and climate commitments. They ask whether doubling down on fossil fuel infrastructure aligns with Canada's long-term environmental promises. And we can't ignore the industrial carbon price, which is climbing to $110 per ton in 2026. That policy is designed to reduce emissions from large emitters, including oil sands producers. Companies operating in Alberta are already factoring that cost into their long-term planning. If a new pipeline deal improves export volumes and margins, it could offset some of those rising compliance costs. That's the economic argument supporters are making. But here's what affects us directly. If energy revenues rise, governments may have more fiscal flexibility. That could mean less urgency to raise taxes elsewhere. It could also strengthen the Canadian dollar if export flows increase. A stronger loonie can reduce import costs, which matters for everything from electronics to fresh produce that we bring in during winter months. These are not abstract policy debates. They connect directly to what we pay at checkout. At the same time, we need to stay grounded in verified facts. As of now, what we're seeing are confirmations of discussions and strategic alignment around expanding cross-border energy cooperation. Major infrastructure projects require regulatory review, environmental assessment, and often years of negotiation. Nothing happens overnight. Markets understand that. Investors look for signals of political stability before committing serious capital. So when tensions flare in Ottawa over Alberta's direction, that volatility can create uncertainty, and uncertainty can slow investment. For families already navigating tight budgets, the last thing we need is economic instability driven by political infighting. That's why this pipeline story matters far beyond provincial borders. It touches every Canadian household, directly or indirectly. We also have to consider the broader North American context. The United States continues to prioritize energy security, especially after years of global supply disruptions. Canada is already the largest foreign supplier of crude oil to the U.S., and our geographic proximity gives us a logistical advantage that few other exporters can match. When Alberta confirms progress toward a major new pipeline arrangement, it signals that we intend to strengthen that position rather than step back from it. For many workers in Alberta, Saskatchewan, and even parts of Atlantic Canada tied to supply chains, this is about paychecks. It's about stability. Construction jobs, engineering contracts, maintenance crews, rail upgrades, manufacturing components in Ontario, these ripple effects stretch across provinces. We often talk about oil and gas as if it's isolated to one region, but the economic web is national. Our pension funds, including public sector funds, often have exposure to energy companies. That means returns from a stronger export environment can support retirement security for millions of Canadians. At the same time, Ottawa has committed to emissions reduction targets on the international stage. Canada's industrial carbon pricing framework, set to reach $110 per ton this year, is part of that strategy. The consumer carbon tax may have been canceled in April 2025, which provided direct relief at the pump for many of us, but the industrial pricing system remains firmly in place. Companies investing in new infrastructure will have to demonstrate how projects align with environmental regulations and emissions management plans. And this is where political friction can intensify. If federal leaders are perceived as resistant to Alberta's push for expanded exports, that can inflame regional tensions. We've seen this movie before in our country: Western alienation debates, constitutional arguments, and economic grievances that divide Canadians. None of us benefit when those divisions deepen. Financially, we are in a transitional period. With the Bank of Canada holding rates at 2.25% and inflation cooling to around 2.3%, policymakers are trying to maintain stability. A major export expansion could provide a boost to GDP growth. It could improve government revenues without immediate tax hikes. But it could also reignite heated debates over climate policy and Canada's long-term energy roadmap. For families in the GTA renewing a mortgage, for small business owners in the Lower Mainland managing tight margins, and for workers in Fort McMurray wondering about the next project cycle, this isn't abstract, it's personal. We all feel it when economic headlines shift market sentiment. The key question is whether this pipeline deal, once fully structured and approved, strengthens our economic resilience or deepens political divides. And that answer will depend not just on Alberta's ambitions, but on how Ottawa responds and how carefully both levels of government communicate with Canadians. As we move forward, we need to be clear about one thing. Major infrastructure decisions are never just about steel in the ground. They are about the direction of our country. When Alberta confirms progress on a significant new U.S. pipeline deal, it sends a message that our energy sector intends to remain a core driver of national prosperity. For many Canadians, that feels reassuring. For others, it raises tough questions about balance, climate commitments, and long-term planning. What we do know, based on verified federal data, is that our economy is stabilizing but still fragile. With the Bank of Canada's policy rate at 2.25% and headline inflation easing to about 2.3% earlier this year, we are finally seeing some steadiness after years of volatility. But grocery prices are still elevated compared to pre-inflation years. Housing affordability remains stretched in major urban centers, and small businesses are still navigating higher input costs. The cancellation of the consumer carbon tax in April 2025 provided visible relief for drivers and households, but the industrial carbon price, now at $110 per ton in 2026, continues to shape corporate strategy in heavy-emitting sectors. Energy companies investing in new export infrastructure must account for those costs. Supporters argue that higher export volumes can offset compliance expenses and strengthen public revenues. Critics question whether expanding fossil fuel capacity aligns with Canada's environmental trajectory. For us as taxpayers, the central issue is accountability. If this pipeline agreement translates into higher export revenues, we should expect transparent reporting on how those gains benefit Canadians. Are they strengthening provincial budgets? Are they reducing deficits? Are they easing pressure on federal finances? Those are the questions we deserve answers to. We also have to keep perspective. Cross-border energy trade between Canada and the United States has been a pillar of our economic relationship for decades. Expanding that partnership is not unprecedented. But the political environment today is more polarized. Social media amplifies every statement. Markets react to every headline. And in that environment, measured leadership matters. If federal and provincial leaders choose cooperation over confrontation, this development could reinforce economic stability at a time when we need it most. If they choose political theater, the uncertainty could ripple into investment decisions and market confidence. At the end of the day, this isn't about partisan cheering or outrage. It's about our paychecks, our mortgages, our retirement savings, and our national unity. We all want a strong economy. We all want responsible environmental stewardship. And we all want leaders who can navigate both without tearing the country apart. I want to hear from you in the comments. How is this affecting your family? And if you value clear, fact-based reporting that puts Canadian taxpayers first, make sure you subscribe to CA Reporter so we can keep holding our leaders accountable together.